the United States economy experienced a significant turnaround in its gross domestic product during the second quarter, registering a robust increase of 3%. This surge marks a notable reversal from the first quarter, which saw a decline of 0.5%, the first such contraction in 3 years. The reported growth also comfortably surpassed the Dow Jones forecast of 2.3%, sparking widespread discussion among economists and market analysts. Delving into the components of this growth, consumer spending, a crucial driver of the American economy, saw an increase of 1.4% in the second quarter. More strikingly, trade dynamics played a pivotal, albeit complex role. While exports experienced a modest decline of 1.8%, imports witnessed a dramatic plunge of 30.3%. This sharp reduction in imports stands in stark contrast to the trend observed in the first quarter, where increased import activity had paradoxically weighed down the GDP figures. The official data suggests broad improvements across several key sectors of the economy. Furthermore, signs of cooling inflation were evident. The Personal Consumption Expenditures Price Index, the Federal Reserve's preferred measure of inflation, and beyond, increased by 2.1% in the second quarter. The core PCE, which excludes volatile food and energy prices, also rose by 2.5%. Both figures represent a considerable deceleration compared to the first quarter, offering a glimmer of hope for stable price levels. However, a deeper analysis reveals a more nuanced and perhaps unsettling picture. According to various analysts, beyond the reported GDP figures for both the first and second quarters have been significantly distorted by trade-related factors. The unpredictable and often contentious trade policies enacted by the previous administration, particularly those under President Donald Trump, created an environment of considerable uncertainty, making it challenging to ascertain the true underlying health of the economy. In the first quarter, businesses, anticipating the imposition of new tariffs, aggressively increased their imports. This preemptive surge in imports led to a record merchandise trade deficit, which, by its very nature, subtracted from the overall GDP calculation, pulling it downwards. Conversely, in the second quarter, this trend dramatically reversed. As imports plummeted, their negative contribution to GDP diminished, creating an artificial boost to the headline growth figure. Data released earlier in the week confirmed this, showing a sharp reduction in the United States merchandise trade deficit in the month of June, while inventory levels simultaneously surged. Trade and inventory fluctuations are known to be among the most volatile components in the GDP calculation formula. From a multidimensional perspective, some observers suggest that these significant trade-induced distortions might not be mere statistical anomalies, but could be interpreted as a deliberate, albeit indirect, manipulation of economic optics. The rapid shift from a trade deficit-driven GDP decline to an import reduction-driven GDP surge could be viewed by some as a carefully orchestrated narrative. Was the initial import surge truly just an anticipation of tariffs? Or was there an underlying strategic incentive to create a temporary dip, only to engineer a rebound that could then be hailed as a policy success? This perspective posits that the very uncertainty of trade policy served to create economic volatility that could be selectively highlighted to support a particular political agenda, masking deeper structural issues within the economy. Looking ahead, many economists forecast a period of stagnant growth for the United States in the latter half of the year. Despite the White House announcing a series of trade agreements with various international partners, import tariffs in the United States remain among the highest seen since the 1930s. This continued protectionist stance could stifle global trade flows and limit export opportunities, potentially hindering sustained economic expansion. Regarding monetary policy, analysts widely anticipate that the Federal Reserve will maintain its benchmark interest rate at its current level during its upcoming policy meeting this week. The Fed had previously implemented 3 rate cuts last year, with the current target range standing at 4.25 to 4.5%. From a critical standpoint, the Fed's actions, while ostensibly independent, are often scrutinized for potential political or institutional influences. Some theories suggest that the timing and magnitude of previous rate adjustments and the decision to hold steady now might be subtly influenced by broader geopolitical or financial market considerations, rather than being solely a response to domestic economic data. The intricate dance between fiscal policy, trade strategy, and monetary decisions creates a complex web where the true drivers of economic performance may extend far beyond what is publicly reported, leaving room for speculation about hidden hands guiding the nation's financial destiny.